Yes guys, so let's discuss about AS 22, accounting for taxes on income. When we discuss about any standard which is starting with the word accounting, then we are talking about recognition and measurement. Now such recognition and measurement for tax on income. Now what is this tax on income? I'm not referring to tax which is levied in India or outside India, whatever it is. Now any income which is levied on any tax which is levied on any income. Now let's say I have an Indian enterprise. An Indian enterprise has a branch in US. Now the branch in US is basically a resident in US. They are earning some income in US, and such income earned in US is taxable in US itself. That need not be taxable in India. Now in the same way, whenever an Indian enterprise has any other branch outside India, they are subjected to tax by any other government itself. So I am not referring to Income Tax Act 1961 here. I am referring to any tax on income. Now such tax can be levied in India or outside India. So tax on income it may be levied in India or outside India. However, to explain the standard, we'll take examples of Income Tax Act 1961 because probably we can relate to that act very easily than any other income tax act. So, but when we are talking about the standard is not limiting to a tax only Income Tax Act 1961. It also refers to taxes which are levied outside India as well. Now the applicability of this standard to all enterprise. I am referring to level 1, level 2 as well as level 3 enterprises. All enterprises are covered under the scope of standard. Now to begin the standard with, we need to first understand two terms. One is the accounting income and the other one is taxable income. First we'll start with our basic understanding that accounting income is nothing but your net profit in your P&L account. This is your accounting income. Now what is taxable income? Is it not the same as accounting income? Absolutely wrong. If you remember your PGBP, profits and gains from business or profession, you have some disallowances, you have some allowances which are to be considered to arrive at your taxable income starting with your net profit from your P&L. You have some plus minus something you do and some adjustments will give us our taxable income. So your taxable income is income subjected to tax. As per the prevailing tax law. If you remember, there were certain expenses like 40A3 section of Income Tax Act 1961, it has a specific saying that any expenditure which is beyond 20,000, if it is met other than by a cross check or a demand draft, will not be allowed for expense. But we don't have such restriction when we are doing our P&L, because when we are strictly following your accounting principles, any expenditure has to be debited to P&L. Now I don't see whether it is a 40A3 expenditure or 43B expenditure. I don't have any particular criteria like that. Accounting income, we take every expenditure into consideration on an accrual basis. But taxable income, not as such. Because in a taxable income, there are specific deductions which are supposed to be made. Like preliminary expenses have to be amortized over 5 years period. Right? In a similar way, we have certain sections like 43B, where accrual concept is not possible. Like bonus to employees, like taxes to government. They normally don't allow unless and until the amount is paid as per 43B. That same section you can apply here. Now such expenses are allowed as per accounting income on accrual basis, but the same accrual basis is not allowed for taxable income. So I'll start with saying that accounting income is not equal to taxable income. You can take plenty of examples, guys, like your expenditure on scientific research. Now we don't have any specific scientific research treatment or accounting income. For us, everything is a plant and machinery, everything is a normal expenditure. But when you're talking about taxable income, it gives a weighted average deduction, 125% deduction for scientific research, section 35. Now, all those particular specific cases are there when we calculate our taxable income. So in a simpler sense, I'm saying your accounting income is definitely not the same as taxable income. Or I'll put it like this. My tax on accounting income is also not equal to your tax on taxable income. Obviously, when income is not the same, then how will be the tax same on that? So I'm just multiplying with tax percentage. So a tax on taxable income is also not equal to your tax on taxable income. This tax on accounting income is called as tax expense. This tax on taxable income is called as current tax. Current tax is the tax which we actually pay. So what we said was tax expense is not equal to current tax. Tax expense is something that we debit to P&L. It is an expenditure. All expenses should be debited to P&L. So what we debit to P&L as provision for tax is tax expense. But current tax is a tax payable to the government. This is not debited to the P&L. What we debit to P&L is tax expense. Now I have an inequation. I have to make it into an equation. Correct? So to make it into equation, I am putting in something like this. 3 is not equal to 2. Very good. Then to make 3 equal to 2, then there should be some other function which should be used. So 3 is equal to 2 plus 1. Correct? So I'm adding something. Or in a similar way, I am saying that 10 is not equal to 8. Now how do you get 10 is equal to 8 plus 2? So there is some other function which I am adding. In the same way, this inequation, if I have to convert it into an equation, I can put it like this. Tax expense is equal to current tax. Sometimes could be a plus, sometimes could be a minus. Plus or minus something. Now this something which we don't know, we are equating it to tax expense. We call this as deferred tax. We call this as deferred tax. Park the concept of deferred tax aside. We'll come back to seeing what is a deferred tax and how is it identified and all that. We'll park it aside. But coming to a simple logic that my accounting income is not equal to your taxable income, there are certain differences that we see. Now whatever differences we observe in taxable income and accounting income, now these differences between our taxable income and accounting income, to name a few, we have just seen 40A3, 20,000 rupees condition which is there. 43B, which is the expenses which are allowed only on payment basis. We have certain expenses where unless and until TDS is deducted, I will not give you as a deduction at all. Sometimes you see scientific research expenditure. What does scientific research expenditure say? There is a weighted average deduction as per tax Accounting, we don't have such weighted average deduction. So there are few situations where we find that there is a difference between your taxable income and accounting income. Now these differences I'll split into two types. One is called as a timing difference. Other one is called as permanent difference. I'll take easier cases, okay. Let's say 48.3 expenditure, an expenditure which is paid in cash. Let's say 25,000 rupees of cash I have paid for a particular expenditure. Expenditure is expenditure as far as my accounting is concerned. So I'll debit it to P&L. But what will the tax law saying? Anything which is paid beyond 20,000, I will not allow that as a deduction. Very good. So what happens? Automatically my taxable income is higher than my accounting income. Because in my accounting income, I have debited 25,000 rupees as expenditure, but the same 25,000 debit is not there as far as your taxable income is concerned. Now such difference, first of all understand, can I have such a deduction in future? No, over. Now even tomorrow, I can't do anything to make sure that the expense is allowable. But take a 43B expenditure. I have created a provision for bonus. Okay, provision for bonus to employees. Accounting, fine. You can debit the expenditure as to provision for bonus to employees, and such will be a deduction as far as your accounting income is concerned. Accounting income reduces. But tax says 43B, unless and until you pay, I will not give you the deduction. I did not pay it in the current year. Let us say I paid it in the subsequent year. What happens? The deduction will be allowed in the subsequent year in case of tax. Now, in the next year also, will I get it for accounting income? I won't get it for accounting income anymore. Because once it is done on accrual basis, again I can't give it on cash basis. So I've already given it on the accounting income in the previous year. The same deduction is given from the taxable income in the subsequent year. Now, such differences are called as timing differences. Because there's a timing difference of 1 year. Accounting income debited the amount to P&L in the previous year, taxable income in the subsequent year. But there are some permanent differences like 48.3 expenditure, 20,000 above expenses. Well, if you paid in cash, it is never allowed as an expense. Now subsequently I can't rectify the transaction in any manner, so that will be always a disallowance. So they are called as permanent differences. Let's say amount paid as TDS. Amount paid as TDS without deduction of TDS, what happens? The amount is permanent disallowance. Now later point of time, if I deposit the TDS, that is not coming up because the payment is already made. And such payment for an expense will not qualify for deduction as far as taxable income is concerned. There is a particular expenditure which has the components of both. Scientific research. Let's say an expenditure on scientific research, I purchased a machinery for 100 rupees. 100 rupees machinery purchase, according to my accounting income, I will say it is a plant and machinery, I will depreciate it over the useful life. Let's say 5 years useful life. Every year I am debiting 20 rupees, 20 rupees, 20 rupees as depreciation. But what is your taxable income saying? Taxable income, scientific research expenditure, weighted average deduction. Now let's say that weighted average deduction is considered at 150%. That means for every 100 rupees of expenditure incurred, I am allowing a deduction of 150 rupees from the P&L. Now understand, you have deducted 150 according to your taxable income, but in your accounting income, how much are you giving a deduction? 20, 20, 20 over 5 years, the maximum deduction that you can give is 100. I cannot give the deduction towards 150, right? So what is happening? To the extent of 100, I will call them as timing differences. Accounting is giving in 5 installments, taxation is giving in 1 single installment. But to that extra 50, which is given as a deduction according to your tax, that can never be a deduction in accounting. Because accounting says maximum depreciation can be only to the extent of cost. Beyond cost, I can't depreciate an asset. So that extra weighted average deduction of 50 rupees what you got for that scientific research expenditure cannot qualify for a deduction at all. Such differences are called as permanent differences. Like this, we call a few as a timing difference and few as permanent differences. Timing differences, depreciation, because what happens in depreciation according to your accounting is completely based on AS6, but taxation on block of assets basis, on WDV basis you have, but the depreciation will not be the same. There will be a difference in the depreciation, but under both concepts, I can't depreciate beyond the cost of an asset. So maximum depreciation that can be allowed is only the cost. So they will match sometime, but not now. Initially there will be some difference. Now this is a depreciation impact. Expenses subjected to 43B. 43B are those expenses which are allowed as deduction from taxable income only on payment basis. They are not allowed as a deduction on accrual basis. You can take for permanent differences any expenditure paid beyond 20,000 in cash. Expenses paid in cash beyond 20,000 rupees. Section 48(3). Expenses without deduction of TDS, that can also be taken as permanent difference. And that weighted average deduction portion of scientific research expenses, that can be taken as permanent difference. Plenty of permanent differences, guys. Just understand that there are permanent differences and timing differences. That is sufficient for me. Now, we have borrowed a concept of deferred tax here, and we said this will be the difference between your taxation on your taxable income and your tax on your accounting income. The difference is named as deferred tax. So what is the differences between accounting income and taxable income? We have split them into two parts, permanent differences and timing difference. Coming to the permanent differences, he says, no deferred tax recognized. I will not recognize a deferred tax for permanent differences. I recognize a deferred tax only for timing differences. Now, whenever we come to this concept of recognition of deferred tax, there are two types of deferred tax. One is called as a deferred tax liability. Other one is called as deferred tax asset. Discussing about deferred tax liability, the standard is completely silent. That means you can recognize deferred tax liability as you wish. The standard will not stop you from recognizing deferred tax liability at all. But the standard has a particular set of rules for recognizing a deferred tax asset, and this particular set of rules is called as check for prudence. I'll come back to your check for prudence. Let's get back to this equation now. We have seen a particular equation saying that tax expense is equal to current tax plus or minus deferred tax. Now, when does it become a deferred tax asset? When does it become a deferred tax liability? Let's see from this equation. Tax expense is equal to current tax plus or minus deferred tax. Now if I am going by the equation approach to understand whether it is a deferred tax asset or a liability, I'll put it in a simple way. If you have a plus deferred tax here, then it will become deferred tax liability. If you have a minus deferred tax here, then it becomes a deferred tax asset. Simplest way of identifying. That means, let's say your tax expense is 80. Your current tax is 100. 80 is equal to 100 minus 20. That minus 20 when I got, I'm using the minus symbol, so that 20 will become a deferred tax asset there. Now, let's say this was 120 and this was only 90. So tax expense 120 is equal to 90 rupees of current tax. To make it an equation, plus 30. When I used a plus symbol, it is a deferred tax liability there. Sounds very illogical when we are talking about accounting concepts. So let's use some accounting in identifying this. Now what did we say? What is debited to P&L is your tax expense, correct? So when I record an entry, it should go something like this. P&L account debit. What I debit to P&L is a tax expense. What I consider as provision for tax. To provision for tax. This is my current tax. Obviously we said both are not the same. Both are unequal items. So obviously the entry will not tally. Now to make the entry as tallying, so what should I do? Either I need to plus or minus deferred tax here. Now let's say my tax expense is more. If my tax expense is more, my debit is more. So when my debit is more, in such situation, I'll have to credit deferred tax here. I'll have to credit deferred tax if my tax expense is greater than the value of current tax. Now you tell me what has a credit balance. Use your simple accounting. What has a credit balance is basically your liabilities. As simple as that. Now if you observe, it is the same thing. If your tax expense is greater than current tax, then tax expense is equal to current tax plus deferred tax. And always when you have a plus sign, it is a deferred tax liability. Let's say for example, your tax expense is less than the current tax. Current tax is greater. So what happens? Debit is less, credit is more. To tally the entry, I have to write something in the debit. So what we write something in the debit is again deferred tax only. When my tax expense is less than current tax. What has a debit balance is nothing but your assets. So I'll record this as deferred tax asset. Now this is an approach which we follow by using an accounting entry. By a journal entry we can follow like this. Our first method was a equation method or equation approach. The second one is your journal entry approach. Anything is fine, both are giving you the same answer. Both will come up with the same answer. The other one we go by a logical approach. What is this logical approach? In the sense, let's take a timing difference like 43B. An expenditure which is allowed as far as your accounting income is concerned today. In the current year, I have debited it to P&L. So what happened? My tax expense is low. My tax expense my accounting income has reduced because I have debited the expense. But taxable income I can't reduce because that amount is only allowed on payment basis. So my taxable income is high. If your taxable income is high, your current tax is automatically high. Correct? That means what is happening? This is the tax payable. I paid higher amount today. I paid an extra amount today. The extra amount what I paid today, I will get as a deduction when that amount is actually allowed as expense. When is the amount allowed as expense? In future when I pay. So amount paid today, benefit received in future, and obviously it becomes a asset. It is something like any asset. Take a furniture. I pay amount today, I buy the furniture. And I'm getting the benefit of using the furniture over future periods. Same thing. I'm paying higher tax today. I will get a benefit of tax deduction from future tax. So got it? So it is similar to asset. That is a logical approach. So if you pay lower tax today, compensated by higher tax payments in future. So I'll call this a deferred tax liability. Because a future outflow of resources will happen. Future outflow of resources is a liability again. So you can call them as deferred tax liability. Got it? Definitely we would prefer these two approaches. Now, like we said, in a deferred tax liability, there's no particular recognition restrictions at all. There's no restriction. You recognize deferred tax liability how much ever you want. Because if you observe, there's only a debit to P&L that is happening when you're recognizing a deferred tax liability. He will never stop you from recognizing something as a debit to the P&L. He is not bothered about it. What I am bothered about is when I recognize deferred tax asset. Because my charge to P&L will reduce when I recognize a deferred tax asset. So, when it comes to the deferred tax asset, he pulls up the concept called as check for prudence. Recognition of deferred tax asset. And we said we have to check for prudence. Now what is a check for prudence? He says, very good. You have a deferred tax asset. That means I paid higher tax today. Something like 43B expenses. I paid higher tax today, that will be allowed as a deduction in future when the amount is actually paid. Very good. But who told you that future you will be having profit? Now there is no particular rule that in future you have to make profits. If I do not make profits in future, then there is no tax payable only in the future. If I have no tax payable in the future, what benefit did you get by paying higher tax today? I paid higher tax today, very good. But tomorrow when the expenditure is being allowed, I was already reporting losses. If I am already reporting losses, if you still deduct an expense, what is happening? Higher loss. Is there any reduction in your tax liability? There's no reduction in tax liability. Earlier also it was zero. After the deduction also it was zero. So what benefit did you get from that expenditure is what he's asking in check for prudence. So he says that there should always be, when you are checking for prudence, always there should exist a reasonable certainty of future profits against which deferred tax asset can be realized. Reasonable certainty of future profits against which a deferred tax asset can be realized is your check for prudence. How do I establish a reasonable certainty of future profits? Now this is the highest difficulty. How do I establish that there is a reasonable certainty that I'll earn profits in future? Every businessman is there with a reasonable certainty. Otherwise, why will he continue doing a business? I will not continue doing a business if I know that I'll be making a loss in future. What is the point for me to continue with the business? So every businessman will say that I have a reasonable certainty. So what happens? Your recognition condition has become very vague if I leave it like that. Now how do I establish this condition of reasonable certainty? Now he'll put it up in this way. It is probably difficult for you to establish that you will earn profits in future, correct? But to establish reasonable certainty, I do not want you to establish that you will be earning profits. I just want you to understand that I do not have a reason to believe I will make losses in future. I am putting it the other way around. I am saying that I may not earn profits in future, but I don't have a reason to believe today that I'll make loss in future. Let's say, over the past few years I've been making profit. If someone will ask you all of a sudden, will you make a similar profitability in future? I don't know. I'm not really sure. If the market conditions are in the same way, probably I will be making the same profit or even an extra profit sometimes. But to the extent of what we believe today, I do not have a reason to believe that I'll be making a loss in the future. He says that is sufficient. He says that is sufficient for you to establish that there's a reasonable certainty of making profits in future. I do not want you to establish that there will be a loss in the future, that there will be a profit in the future. But I just want an assurance that you have no reason to believe that the enterprise will suffer losses in future. That is sufficient to call it as reasonable certainty. Your reasonable certainty is just a reason, no reason to believe that there will be a loss. Market has been in the same way. I have been holding the same position in the market. I don't have a reason to believe that I'll be making a loss in the future. There's no substantial shift in the market. Let's say I've been adopting a particular technology or I've been selling a particular technology in a particular industry. I've got a news today that there's a radical change in the technology being followed by this industry. Now, that news that there is a sufficient radical change in the technology followed by the industry could be a reason to believe that the enterprise will be making loss because my technology has now become outdated. I may not be able to sell the same number of units. I may not be able to sell the units in such a way that I'll make profits in the future. Now, there is certain evidence which is coming up. There is certain reason for which I'm believing that I will be making losses in future. Now, there's no substantial reason for me. Everything is going in the same manner. I don't have a reason to believe. Earlier I made profit. Now also I'm expecting that I'll make profit. And there's nothing wrong in expecting like that. That is sufficient to establish reasonable certainty. But reasonable certainty is easier to establish for any company which is making profits in the past. If someone is making profits in the past, I'll say, yes, I made profits in the past. I'm expecting I'll make profits in the future. But let's say, for example, someone has been suffering losses in the past. Someone has been consistently suffering losses in the past. Standing today, can you recognize the deferred tax asset? Now, can you establish that I have no reason to believe that I'll make loss in the future? There's every reason for you. There's every reason for you to believe that you'll be making losses in the future because your past track record has been indicating that the company has been suffering losses invariably. So the same loss I will also expect in the future is what he says. Because I'm talking about a word called as reasonable certainty. Now, here comes a situation when we are checking for prudence. Any deferred tax asset, I can't establish reasonable certainty for every enterprise. Especially for enterprises which have been making losses in the past, I cannot establish reasonable certainty at all. Because here we are saying no reason to believe that the enterprise will make loss in the future, but someone who has been suffering losses, I will say I have sufficient reasons to believe that they are making even losses in future. So does it mean that a company which is suffering losses should never recognize deferred tax asset? No. Now here comes up a condition here. For these particular two things, one is carried forward business loss, and for unabsorbed depreciation. Carried forward business losses. Last year's business loss can be set off against future profit for 8 years. Unabsorbed depreciation, if the profits earned by the enterprise are not sufficient to absorb the depreciation also. then I'll call it as unabsorbed depreciation. Unabsorbed depreciation has infinity. You can carry forward for how many number of years you want. In these two cases, I cannot establish reasonable certainty. This is not possible here. This is not possible. Because the company has been suffering losses in the past. So I can't have a reasonable certainty. So I'll substitute this term with the word virtual certainty. When I use the word virtual certainty, he'll combine it plus convincing evidence. Now let us say a company has been drawing a graph like this. He is presenting it to his users of financial statements. This indicates my past. This indicates my future. This being the number of years. My y-axis showing the profits. Obviously, this is a loss-making zone. Let us say this fellow is lying here in the past. Now he has indicated in his financial statements. This is his projection now. There is completely a projection for the future. So when I'm talking about the future period, then I'm only talking about the projected profits. Virtual certainty, true, because the management is believing that there will be sufficient profits in the future. Convincing evidence. Where is the convincing evidence? Can I take this graph as convincing evidence? Now that fellow will give a graph. Even everyone will give their own verdict of what they believe. Now I believe that I'll write 800 marks of CA final exam and score 790 marks. Possible. Now, belief when it comes to, I can't put up whatever I want. Now this is the same situation what is happening if you observe. When I'm using the word virtual certainty, doesn't make sense. If I stop with virtual certainty, every businessman is there with a hope that they will make profits in future. Now even if I'm suffering losses, every businessman will tend to believe that I'll be making profits in future. Now that is a reasonable belief for every person. So I'll say there's a virtual certainty for me to make profits in the future. That is why I'm continuing this business. But I am not stopping with virtual certainty. That is the reason why I put up a word called as convincing evidence. Let us take the example of a practical case. There's a garment store called as Basics. Basics was a garment store which was basically into establishing retail outlets everywhere. Probably around 2006 to 2010 period, they had multiple retail outlets. Almost every particular place you had a retail outlet of Basics. When he was establishing such retail outlets, the problem he faced was, he was making operating profits. But too much of non-operating expenses have been eroding his profitability into losses. Rent space, advertisement, lighting, electricity, staff salary. Now so much of expenditure was incurred which was not operating for what could be his operating expenses? The cloth, the stitching, the tailoring, all the designing. Now these are his operating expenses. Now these are selling and distribution expenses which have eroded his operating profits. So what could be the possible shift in the decision here that he could have taken? In 2010 he has taken a decision saying that I'll shut down all my retail stores. I'll only set up online stores now. So all the retail stores were shut and online marketing was started. Now for the online marketing, let's say he has put in some cash and all the products were put up online and he started selling. Now if you observe, until 2010 when he was suffering losses, I'll say that there's only a virtual certainty that will bring up into profits. I do not have a convincing evidence because there's no shift in the business. He's been doing the same business. He has been occupying the same premises. He has been paying the same rent. Now what sudden convincing evidence came into picture that virtually certain that there will be profits in future? Nothing. But the decision which he has taken in 2010, identifying that the profits have been eroded by selling and distribution expenses. If I cut down on these expenses and tomorrow I'll be making my profits, that is sufficient enough convincing evidence. There's a convincing evidence because earlier in the previous year from 2006 to 2010 I have been observing operating profits. But such operating profit eroded by selling and distribution expenses, if I eliminate the selling and distribution expense or reduce the selling and distribution expenses, there is a virtual certainty. Seeing my past, I can't get virtual certainty. But in the future, taking the convincing evidence that I have withdrawn from the retail outlets, I have gone into online marketing, I have made efforts to reduce my selling and distribution expenses, sufficient convincing evidence to find out that there is a virtual certainty of bringing the profits into future. Got it? So this is called as virtual certainty combined with a convincing evidence. Combined with a convincing evidence here. Now this is what we talk about, and this convincing evidence concept has been explained in Accounting Standard Interpretation 9. What does ASI 9 say? ASI 9 just says that it is not a management estimate. Convincing evidence is not a management estimate. I can't give this graph and say that, see, I've given a graph, this is my convincing evidence, not proof. This is only your expectation. I don't want expectations, I want evidence. When I use the word evidence, what he wants is, I want a statement of fact. I want a statement of fact. A statement of fact will support a convincing evidence or will suffice as a convincing evidence to give a virtual certainty of sufficient future profits. Now, this is basically what we discuss about when we're talking about your carried forward business losses and unabsorbed depreciation. Though we have used the term reasonable certainty for check of prudence for other deferred tax assets, when we want to recognize the deferred tax asset, when it comes to the case of carried forward business loss and unabsorbed depreciation, I can't use the word reasonable certainty anymore. I have substituted this word reasonable certainty with virtual certainty combined with, in addition with a convincing evidence. Such convincing evidence is not a management estimate, but I want it to be a statement of fact here. Now, a very interesting practical case if you observe. Again, I'll date back to 2005, 2006. Normally, India gives 5-year plans. Once came up a 5-year plan which said that India will be encouraging the production of biodiesel. Okay, biodiesel basically is a product which can be a substitute for diesel, but it is out of a renewable source. It basically comes from palm oil. So an alternative source of energy, probably a more cleaner source and a much cheaper source for diesel or substitute for diesel. There were plenty of companies which were outside India which were interested to set up their establishment in India. They have identified a place in India where there is abundant, availability of palm oil, and they have established units in India. Now, after establishing units in India, like we know, India implementation of a policy is not as easy as they declare a policy. I also declare hundreds of policies, but we don't really adopt those policies or we don't really implement those policies. Same thing happened. Though they have encouraged them to establish the units, the problem was diesel was a subsidized product back then. That means, let's say the cost of production was 60, I was giving 15 rupees subsidy on diesel. So I'm making diesel available to every person at only 45. But biodiesel, on the other hand, had a cost of only 50. But there was no 15 rupees subsidy on this. So what happens now? You can't call it as a substitute because diesel was available at 45, biodiesel available at 50. What kind of a substitute are you? Because the substitute needs to be lower than the price of this product so that people will start adopting the biodiesel. That is not the case. From 2006 to 2010, same situation happened. Until 2011, 2012, the same situation was being adopted. All these biodiesel plants which were put up, they started producing biodiesel, ultimately sold nowhere. They had continuous losses, most of them shut down. But then came in 2012, reaction a bit slower. Then the government of India said, I won't give any subsidy to biodiesel, but I can do one more thing. I will withdraw the subsidy on diesel. If I withdraw the subsidy on diesel, again diesel, that 15 rupee subsidy if you remove, it starts trading at 60. In comparison with biodiesel, which is only having a cost of 50, again now biodiesel has become a competent product, and it has become, and those enterprises which are into biodiesel can definitely say that there could be a possibility of future profits there. Now if you observe, for such an organization I have been going and I have been performing an audit standing in 2012. If I take my past track record, continuous losses are there. Can I record deferred tax asset? Not possible, because we see this concept of reasonable certainty. There is no reasonable certainty because the company has been suffering losses. But for these two items, for carried forward business loss and unabsorbed depreciation, I can establish virtual certainty with convincing evidence, because the statement of fact given by the government that they are withdrawing the subsidy on diesel is sufficient convincing evidence for me, which will prove that that means in future the company will be earning profits, because now biodiesel has become a cheaper substitute for diesel after the implementation of the policy. So what happened? Suddenly, all of a sudden, after 6 years or 7 years of the enterprise being established, I am identifying this virtual certainty concept. Got it? So this is one such example where we see the virtual certainty combined with convincing evidence. That is the reason why I said convincing evidence when I talk about, it cannot be taken as a management estimate. It should be a statement of fact for you. Got it? You can take down one or two examples for this. Very similar to this peculiar concept of carried forward business loss and unabsorbed depreciation is also loss under head of capital gains. Because loss under head of capital gains, I cannot set off this loss against whatever I want. I can set off these losses only against the profits under the same head of income. So I need to have a gain under capital on sale of a capital asset, only under which I can set off this. So even in this situation, I'll use the same terminology. Virtual certainty supported by convincing evidence. This has been given in an accounting standard interpretation 4. Now, try to read within the context. Try to read along with the context. Loss under head of capital gains, it can be recognized as a deferred tax asset. When do you recognize? When there is a virtual certainty supported by convincing evidence, I can recognize a deferred tax asset. Recognize deferred tax asset when I have virtual certainty supported by convincing evidence. How can I have a virtual certainty in the case of capital gains? Loss under head of capital gains can be set off against profits on sale of asset. So, virtual certainty can be proven this way. In future, on sale of a particular asset, I will earn profit. Now, how do you establish? Let's say the present market value of that particular product or particular asset, capital asset, is more than the book value. book value of a particular land, let's say I purchased the land only at 1 crore, but today the value of the land is standing at 4 crores. So obviously when I'm selling the asset, I'll get a profit of 3 crores. Virtual certainty. Not sufficient. He said convincing evidence. What convincing evidence do you want? Now I have a land, I said. Did I say I will sell that land? I never said I will sell that land. If I sell that land, I will get. That is virtual certainty. But do you have a convincing evidence that you are selling the land today? I don't have a convincing evidence, then you can't recognize the deferred tax asset. So there should also exist a convincing evidence that you have an intention to sell this asset. I am having an intention to sell this particular asset whose fair value is more than the book value. I will be earning a capital gain on this. Such capital gain can be set off against the capital loss which is incurred. Then I will say that there is a virtual certainty of future profits combined with a convincing evidence that is my intention to sell that item. That is sufficient convincing evidence, and then we can say that we can recognize the deferred tax asset for those loss under head of capital gains. Got it? So reading with that context, that is what you see as far as ASI 4 is concerned. So according to ASI 4, when I say virtual certainty, then I am saying that market value is more than book value of a capital asset. For a capital asset, when my market value is greater than the book value, then I will earn capital profits in future. Now that is virtual certainty. But what did he say? I use the word convincing evidence. Convincing evidence is his intention to sell the capital asset. That land which is there with me, I have used it for the construction of a building on that property. I am constructing a building on that property. Where do you have an intention to sell that property? I do not have an intention to sell. When you don't have an intention to sell, even though your market value is greater than the book value, it does not give you any right to recognize deferred tax asset for the loss under the head of capital gains. This is the concept where we can talk about your reasonable certainty and virtual certainty. Now, sometimes you need to understand now, not every enterprise will be in a position to recognize the deferred tax asset because of the restriction which is put up, reasonable certainty or virtual certainty. I might still have carried forward losses, but I still might not be in a position to recognize a deferred tax asset for it because I cannot prove a virtual certainty with a convincing evidence. So such assets will be left off like that. Now, whenever you have such situations, we have to discuss also about review and reassessment. Of deferred tax asset. No liability concept coming up. I'm only discussing about deferred tax asset, that's it. Review and reassessment. What is a review? What is a reassessment? Or what do you review and what do you reassess? Review. When I'm talking about review, I'm talking about a review of deferred tax asset not recognized earlier. What I did not recognize earlier because I did not satisfy the conditions of virtual certainty or reasonable certainty, I will review, reassess deferred tax asset already recognized in previous year. Last year I have already recognized. That previous year I have already recognized deferred tax asset where I could establish reasonable certainty and virtual certainty concept. So that is reassessment. I have already assessed the deferred tax asset. I am reassessing it. I am finding out whether it still holds the same virtual certainty and reasonable certainty concept. My review and reassessment of deferred tax asset should compulsory take place for each balance sheet date. Each balance sheet date I will have to review and reassess. Compulsory review and reassessment has to be done for deferred tax asset. Reviewing those timing differences which are not recognized as deferred tax asset earlier because you did not satisfy the condition of reasonable certainty and virtual certainty. Reassessing that deferred tax asset which is already recognized in the previous year, whether it is still satisfying the conditions of reasonable certainty and virtual certainty, should happen compulsorily every year. Till now, if you talk about, we were only discussing about recognition. But there's also a concept where we have to discuss about measurement. So we have to talk about measurement of deferred tax. How do I measure a deferred tax? I recognize the deferred tax asset, very good. But how do I measure it? Measurement of deferred tax. What did we say? It's only the timing differences for which we recognize deferred tax. So I recognize the deferred tax like this. My deferred tax asset or a deferred tax liability, whatever it is equal to timing differences. Timing difference is only income. It is not tax. Multiplied by tax rate. What tax rate? Now this tax rate is talking about which is enacted or reasonably enacted on balance sheet date. Let's take very recently we have seen a situation where corporate tax has come down from 30% to 25%. Let's say the budget session has been announced on February 28th. I don't know the exact date. I'm just giving a random date. Feb 28th, the finance minister has given a condition saying that from the subsequent financial year, your corporate tax rate has been reduced from 30% to only 25%. Very good. What was the prevailing tax rate when you are recognizing a deferred tax asset? 30. But when are you recognizing the deferred tax asset for? Deferred tax asset or liability is supposed to be realized in future. A liability, deferred tax liability means I have to pay in future. Deferred tax asset means I will get that deduction in future. What is your future tax rate? What is that future tax rate for you? Though the current tax rate is 30%, I can't take 30% to recognize the deferred tax asset or liability. I will start considering 25% because law is already passed. On February 28th, when the budget session has been announced itself, the law is substantially enacted that the percentage will be only 25. In such situation, I will not have a same current tax rate. My tax rate will be a different rate whenever there is a change in the tax. If you observe in the given example where I've taken a company SIC or a partnership where there is a flat rate. A flat rate of 30% is applicable or a flat rate of 25% is applicable. But when I'm talking about the applicability of this standard, I said it is applicable to all enterprises. So should be applicable even to the individuals and HUFs as well. But individual and HUF tax rates are not straight rates. They are not a flat tax rates what I have. What I have for individual and HUF is slab rates. When I have a slab rates applicable, then what tax rate do I consider? If slab rates of tax apply, use average rate of tax. This word average rate of tax is discussed in section 89 of Income Tax Act, I guess, where we discuss about relief. Not really sure. I'm just giving you an estimate where it has been already there. But as far as your standards is concerned, I will use this word average rate of tax twice. One in AS 22, other one in AS 25. At the time when we discuss AS 25, I'll tell you how I use this word average rate of tax there. Now, how do I calculate this average rate of tax? There's no standard formula which is given, but I'm taking the formula from income tax itself. Average rate of tax is equal to tax on taxable income divided by total taxable income into 100. This will give me my average rate of tax. Tax on taxable income divided by the total taxable income into 100 will give you average rate of tax, which can be used for recognizing a deferred tax asset or a liability when slab rates of tax apply. Now, whenever I'm talking about deferred tax, I'm talking about a future event. Correct? If I have a deferred tax asset, means I'm paying higher tax today, I'm getting the benefit in the future. Deferred tax liability, today I'm paying lower tax and such amount will be compensated by higher tax payments in the future. Whenever I'm referring to a future period, I have to always present it on a discounted basis because I'm talking about a future event. Now, future tax flows or future cash flows should always be presented today on present value basis. That is on a discounted basis. But unfortunately, if you observe, when will you receive that benefit? I don't know. In future. Which year in future? I don't know. Year 2, year 3, year 4, year 5, year 10, year infinity. Unless and until you know what is the year, I cannot identify the present value. I can't get the discount rate only. If I ask you to calculate discount rate of 15%, how will you ask? Which year? Discount rate for first year, second year, third year. I have two determinants of a discount rate. Percentage as well as time. Now here I don't know what is the time. I might get the benefit in the second year. I might also get the benefit in the third year. I might also get the benefit in the fourth year. Now which year am I exactly getting the benefit? Not possible. My deferred tax liability I am supposed to pay. I might supposed to pay it next year. I might be paying it the third year. I might be paying it in year 9 also. I don't know. So whenever there is an uncertainty which is cropping up, such uncertainty will always force you to present DTA or DTL on undiscounted basis. They indicate future cash flows, absolutely correct. But such future cash flows, I don't know which year they belong to. So when I don't know which year they belong to, I can't discount it. I cannot identify a present value factor for them. Since present value factors cannot be identified, I can't identify the present value factors. I don't know in which year I will have to pay extra tax, in which year I'll be having a deduction from tax. I have no idea. When I don't know the year, I don't know the PVF. When I don't know the PVF, present it on undiscounted basis. This is your logic regarding your deferred tax, measurement of deferred tax. Then come to the concept of disclosure. disclosure. I've started with the recognition. I said two conditions, reasonable certainty, virtual certainty, whatever it is. Then we came up to the measurement. Then we said present it on undiscounted basis. Last concept that we have to discuss is disclosure of deferred tax asset or liability. Now how do I disclose? Standard puts it up very simple. In very simple sense, he says DTA or DTL should be presented distinctly from other assets and liabilities. Now define distinctly. How do I define distinctly? Distinctly means where? Now, when you have such a very vague term which is coming up, saying distinctly you show in the balance sheet, where do I show distinctly as from other assets? Now there is no particular placement which says distinct from the assets. So that is the reason why to explain this word distinctly, we pull up a concept of ASI 7, Accounting Standard Interpretation 7. Now what is this ASI 7 talking about? Now your ASI 7 which we'll talk about is only for non-corporate entities. I'm only talking about non-corporate entities. I'm not talking about corporate entities at all. Reason is, corporate entity is a company registered under Companies Act 2013 or 1956. They follow Schedule 3 for presenting their balance sheet. When there is already a Schedule 3 which is in picture, which is telling you how to disclose, then why do I need a separate disclosure again? So, corporate entities follow Schedule 3 happily, but what I'm discussing about is only non-corporate entities, how do they disclose? For non-corporate entities, what we discuss about in ASI 7 is deferred tax asset should be disclosed above current assets, below investments. Deferred tax liability above current liabilities, below loans. As a separate line item. Because he used the word distinctly, I need to take it as a separate line item. Now, such placement of deferred tax asset and liability is what we are discussing here. Like I said, corporate entities, you don't have to discuss ASI 7 at all. Any corporate entity, ASI 7 is not applicable for them. They follow Schedule 3 of Companies Act. (2013). Any corporate entity, you don't have to follow ASI 7. You can take the concept of Schedule 3 of Companies Act 2013. Now, there are some other parts of the standard which are discussed about not in the standard but as separate interpretations. Let's discuss about them. But actually, if we talk about the standard comes to an end after the disclosure. That is the maximum that can be contained in a standard. Recognition, measurement, presentation, disclosure. I started with the recognition, we have understood the measurement, there was presentation, we have seen the disclosure. Actually the standard should end. But since there are complications which are put up, so we have to discuss them as separate accounting standard interpretations. So let's take up ASI 3 and ASI 5. I am taking those standards on a combination basis because both have the same presentation. ASI 3 and ASI 5. Accounting for deferred tax. During tax holiday period. Or tax holiday period in the sense, for that particular period, for a set of years, 5 years or 6 years or 10 years or 3 years or whatever it is, for that particular period you don't have to pay tax. That is called as tax holiday. Now this tax holiday period, I needed two separate IND-AS because there's section 10A, 10B which we'll discuss about it. And at the same time I have section 80 IA, IB which we'll discuss about it. That is the reason why I needed two IND-AS. So accounting standard interpretation 3 as well as ASI 5, because there are two sections which talk about tax holiday period according to your Income Tax Act. Now what is the specific recognition which I am talking about in this? Understand in a simple sense, there's a tax holiday period. In the sense, for that particular period, there is no recognition of tax only. I don't have to pay tax. Let us say this enterprise was exempted to tax from year 1 to year 5. From year 6 and so on, he starts paying tax. There was a timing differences. Arising, reversing. Year 1, let's say a timing difference of 100 arised. Every year from the subsequent year, let's say it was reversing at the rate of 15 every year. Year 2 it reversed 15, year 3 it reversed 15, year 4 it reversed 15, year 5 it reversed 15. The total reversal up to the tax holiday period ended is 60. There is furthermore 40 which will be reversed after the tax holiday period. Now guys, during this period when I'm talking about year 1 to year 5, am I paying any tax? Zero. So what is the point of recognizing a deferred tax asset or a liability when the tax liability itself is zero? Now there is no point of taking a deferred tax asset or liability for this period. No deferred tax. Because it is a tax holiday period. So for any timing differences which is arising or reversing during the tax holiday period, I will not recognize any deferred tax asset. Absolutely wrong. He'll say that out of this 100 rupees which you see here, which is arising in year 1, I will not create a deferred tax asset for 60. No deferred tax for this. But for this 40, I will create a deferred tax. Reason, this 40 is reversing after tax holiday period. Got it? So when the tax difference is arising in year 1, I have to identify what is the tax timing differences reversing during the tax holiday period. To the extent of timing differences reversing during the tax holiday period, I will not recognize any deferred tax. But to the extent of the timing differences which are reversing subsequent to the tax holiday period, I will have to recognize a deferred tax. This is what is given as far as your ASI 5 and ASI 3. recognize deferred tax. That means it could be a DTA or a DTL. For timing differences arising during tax holiday period, but reversing after the tax holiday period. So for a timing difference which is arising but reversing after the tax holiday period, that is after year 5, I recognize the deferred tax to the extent of 40. For the timing differences which are reversing during the tax holiday period, no recognition of deferred tax. So no deferred tax for timing differences reversing during tax holiday period. There's one more confusion which was created. He said 40 rupees you have to recognize the deferred tax because it is reversing after the tax holiday period. Absolutely correct as per ASI 3 or 5. Now he's saying, should I recognize deferred tax in year 1, that is during the tax holiday period itself, or should I recognize in year 6 after the tax holiday period is completed? Then he says you can add that small statement here, when the timing difference arises. Oh, not when it is reversing, but it should be during the period when the timing difference is arising. So in year 1 itself, I will recognize that 40, not at the end of the tax holiday period. Because the timing difference arises in year 1, I will recognize the deferred tax to the extent of 40 in the year 1 itself. That is recognition of deferred tax during a tax holiday period. Another accounting interpretation, accounting standard interpretation, ASI 6. Recognition for tax when liability is determined as per section 115 JB of Income Tax Act. (115 JB) is nothing but MAT, minimum alternate tax. Standard might sound, interpretation might sound very big. Explanation is very simple. He said, your current tax is equal to tax liability as per the provisions of Income Tax Act. But it is not equal to tax payable as per section 115 JB. So what am I saying? So whatever current tax you pay, that current tax as for 115 JB cannot be considered for the purpose of AS 22 at all. AS 22 is not talking about current tax payable as for 115 JB. I'm only talking about the general provisions of Income Tax Act. If your general provisions of Income Tax Act are determining your taxable income in a particular manner, only to that extent you recognize current tax. I do not take into consideration 115 JB calculations at all. In a simpler sense, my deferred tax asset or a deferred tax liability are not recognized on the basis of section 115 JB. I will determine the deferred tax asset and liability based on the tax liability as per the normal tax laws. I will not take into consideration MAT at all. Then comes MAT credit. MAT credit also discussed under 115 JAA. So JA, MAT credit cannot be recognized, not recognized as deferred tax asset. I am not considering 115 JB only. From where will I recognize? I am not supposed to consider 115 JB in your computations of deferred tax at all. So if you round up basically the number of interpretations that we have seen ASI 3, ASI 5, where we discuss about tax holiday period. ASI 4, where we discussed about your capital gains, whatever loss arising under the head of capital gains, where we discussed about virtual certainty supported by convincing evidence. ASI 6 also we discussed, and we have also discussed ASI 7. We have also discussed ASI 9. ASI 7 were talking about disclosures. ASI 9 was talking about what is your convincing evidence. What was a convincing evidence was given only by ASI 9. So this is put together the entire concept of your AS 22. So AS 6 is again 115 JB. So 3, 4, 5, 6, 7, 9. These are your 6 interpretations which should be read along with your AS 22. Got it? Along with this interpretation, there's a small guidance note which is also talking about guidance note on corporate dividend tax. What is a corporate dividend tax? A tax paid on dividends declared or dividends paid out. Now normally in any P&L, if I talk about any P&L you talk about, a P&L is normally divided into 2 parts. The first part of P&L is called as above line items. And the other one obviously should be called as below line. Now, what is this line? Is it a poverty line which I am talking about? No. This line basically divides. Above line items are all charged against profits. Below line items are always appropriation of profit. Now, why did I bring up this concept when we are discussing about the guidance note? I'll come to that concept. Now, you tell me, any tax which is payable to the government is a charge or appropriation? A tax payable is a charge. It is not an appropriation. But a corporate dividend tax is paid on what? On dividends. What is a dividend? Appropriation. So there is a charge on the profit which is calculated on the appropriation of profit. Because the dividends which are distributed is an appropriation, the tax which is paid on such dividend is a charge against profit. Now where do I show? That is the reason why this corporate dividend tax will be shown as below line only. Even though it is a charge. Can you support? Yes. Because what presentation will it be if I show the appropriation below the line and a charge on such appropriation above the line? Doesn't make sense. So for a better presentation, for a better understanding, I'll write dividend distributed, corporate dividend tax right below each other. But though you talk about a corporate dividend tax which are written below the line, corporate dividend tax on dividends paid is not a charge against, is not an appropriation of profit, it is a charge against profit. But only for the purpose of presentation or for the purpose of disclosure on the face of the P&L, we write it in the below line items even though it is a charge against profit. A small guidance note which can be related along with AS 22. AS 22 does not leave us here, or the concept does not stop here, because we'll have an extract of AS 22 to be dealt along with AS 25 as well, where we talk about interim financial statements. So this is not the end of AS 22 that we discuss, but as such, when we discuss about AS 22, we'll stop it here. A part of AS 22 will have to be read along with the interim financial statements, and we'll discuss that in AS 25, that is interim financial statement. Got it? So this will bring us to the end of AS 22.